Alright, so on the ET Money Show, we make sure that we don't just talk about investing in mutual fund, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Aparna Karnik, who has been managing a DSP Quant Fund since May 2020. Aparna, good evening and welcome to the show. DSP Quant Fund, a thematic fund with a quant model. Before I dive, I get into the details of this fund, I want to understand what exactly do you mean by a quant model, because a lot of investors, the fund is new and innovative, because we know in how 2021 investors have latched on to innovative themes and thematic funds especially, which is why I want to help viewers understand what exactly is a quant model, what are the factors that are considered when a portfolio for such a fund is designed.
Hi, good evening, Kavita, and good evening to all the viewers. Thank you so much for having me on the program. Pleasure talking about quant funds. So basically, I mean, there's a lot of jargon in the usage of this term quant, but like to put it very simply, a quant strategy is any strategy where the stock selection is done using some predetermined formulae or characteristics which can be measured, which are measurable in some kind of a quantitative manner. So any strategy, of this type is called as a strategy which is a quant strategy, or like a model-based strategy. And so most quant strategies, since they are based on predetermined measurable criteria, are essentially use a lot of historical data. Going back many decades, as long as possible, where they're trying to identify patterns or trying to identify characteristics which have demonstrated, some ability to generate excess returns for the same risk, or maybe the similar returns for lower risk. So essentially, most of these, are based on a lot of historical data. And there is also a very large body of work done by academicians and practitioners in this field for several decades now. And that is leveraged in terms of, formulation of quant strategy. So like we mentioned earlier, since any parameter which is measurable can be, the strategy can be based on that. So there can be a wide array of quant strategies, which is why, it's a very generic term. So it's very important for investors to really drill down and understand more details about, what is the actual parameters which are being used in whichever strategy they're considering for investment. So you can have, for example, strategies or parameters which are based on fundamental characteristics like, profitability of a stock, or its valuation parameters, or its growth parameters and such. Or you can have quant strategies which are based on more of price signals, like which are called generally momentum strategies, where essentially they're not really looking at the fundamental parameters, but they are more following certain price patterns or technical signals. And then there are other kinds of strategies where instead of looking at stock level data, they would look at, say, macro parameters data. So like that, there are a wide array of strategies which could be called quant or model driven. So it's very important for investors to really get into the details of what strategy is followed by the fund. Some common ones, like I mentioned, is you can have value strategy, value model. You could have a momentum model. There are several such strategies in the market available today for people to invest. You can have, like a quality strategy, etc. So this, in a nutshell, is how quant models are built.
So Aparna, now getting in depth with these kind of models, could you just explain in short how a fund manager carries out strategies as per each model?
So basically, a lot of these, as I said, are based on historical data and also academic knowledge. So one thing is, for example, there has to be a reason why that particular strategy should deliver excess returns. So for example, a momentum strategy. So if you look at a momentum strategy, essentially what the model does is identify stocks which have performed well on their stock price. And it assumes that by buying such stocks, that same set of stocks will continue to do well in the near term. And the fundamental reason or the reason for this to happen is because we know that there is a sort of a behavioral biases which drive investors, like greed and fear cycles. So investors tend to chase stocks which have done well in the recent past, and that is why say a momentum based quant model has delivered returns over long periods. On the other hand, you could have a quality based quant model. So there you're looking at stock parameters such as returns on equity or dividend payments or free cash flow generation or growth of earnings, visibility of earnings. So generally investors have flocked to these kind of stocks because they have been very steady performers in an uncertain economic environment. So because of their defensive characteristics, they tend to have delivered better returns over, especially turbulent economic cycles. So that's why, say, an quality oriented quant strategy would has delivered returns over the past. So there are some strategies where you can combine more than one factor. So you could have a quality momentum or a value quality. So you can combine such strategies and create your own quant strategy.
All right, now let's talk about DSP Quant Fund. Currently, what is your portfolio mix like, and what's the kind of strategy that you've adopted?
So in DSP Quant Fund, essentially we have a more fundamentally anchored strategy. Quality forms the core of our strategy. So we are essentially looking for or trying to select stocks where they have demonstrated better profits, steady dividends, positive cash flows, historical growth of EPS, etc. So we essentially the quant model that we use at DSP ranks stocks based on all these parameters and buys the sort of stocks which have the best average scoring or exposure to these which we believe are desirable characteristics from a quality perspective. So that's what DSP's quant model and strategy is all about. What was your second question, Kavita?
So in terms of investments, what is the diversification in the portfolio?
Yeah, so given that we are looking at these kind of quality parameters, so our portfolio is the biggest sectoral weights in the portfolio would be financials, much of them being private sector financials and insurance companies. We also have a overweight position relative to the index on technology companies, because they also are very profitable. They have demonstrated strong cash flow generation, steady earnings visibility. We also have good exposure to consumer staples sector and some consumer discretionary and healthcare. So the portfolio is predominantly constructed around these sectors. What we do is that we have like a scheduled rebalance of the model, because we don't want the portfolio to become stale. So every quarter we evaluate the parameters of the stocks based on our criteria, and then we rebalance the weights. And there are sometimes some new entrants or some names go out where the company's fundamentals have deteriorated. So that's how the portfolio is
so you're saying that you rebalance the portfolio every quarter?
Yes.
Okay.
I mean,
how is it helpful?
See, the portfolio doesn't change. So, for example, if I just talk about the December ended quarter, there were no new names which sort of came in and went out. It just helps us to normalize the weights. The model will do, profit booking, essentially normalizing weights of stocks which may have done very well in the past, and just rebalances the weights looking at, the relative sort of attractiveness of stocks. As we have seen, in the recent past, Kavita, and you would appreciate this, there has been a huge amount of sector rotation we've seen in the past 2.5 years, where we've seen very sharp price moves and divergences between sectors and stocks. So that's why it's important to evaluate, how the companies are performing on growth, on quality, how the valuations are moving relative to each other. So we feel it is useful to, sort of take stock of these even on a quarterly, even if there may not be much changes in the portfolio.
The stock allocation limit that's been lifted, how is that helping you churn out good returns for the investors?
So, I mean, we have a very diversified portfolio, of about 46, 47 stocks. And we have very tight rules around stock concentration and stock liquidity. So, for example, no stock, the largest weight we have in the portfolio is 5.5% right now, and it cannot go over 8%. So we've not really, we have a very diversified portfolio. We don't have a large stock concentration in the portfolio at all.
Sectors that you just mentioned were
I'm sorry?
the top 5 sectors where you've invested
So
are?
the top five sectors, yes, financials is the large one because we anchor the fund weights around the index weights to the extent possible. So the top 5 sectors in the fund will also be the top 5 sectors in the index.
Okay. All right. And the specific reason behind it, you're banking on these top 5 sectors?
Yeah, so the way the model works is essentially it will try to find out, basis our quality characteristics, the best stocks within a sector. So essentially it will try to select the best quality stocks in each sector wherever possible. Like there are some sectors which are totally absent in the fund. For example, there is zero weight in communication services. There's very, very low weight in, very cyclical sectors because they don't demonstrate the kind of quality characteristics like that, or energy, for example, is not there in the portfolio. So while there are some sectors which are structurally, absent from the portfolio because they don't exhibit quality the way, we define it, which is essentially high profitability, steady earnings, dividend paying, free cash flow generating. So those kind of sectors would be absent, and all the other sectors are there, but within each sector the model is selecting the stocks which have the best attributes, and the way we define it in terms of our parameters.
So financial consumer staples, technology, materials is what I can see as the top
Yes,
sectors where you have maximum exposure. Now tell us something now, because the strategy is so focused and so rule based, it definitely makes it a very high risk fund.
So we actually don't think that just because the strategy is thematic automatically makes it a high risk strategy. And in fact, if you look at the historical sort of drawdowns of the fund, which means the maximum loss which the fund has seen, in its 3-year plus history relative to the index, or the volatility of the returns of the fund relative to the index, you'll see that it's actually lower than the index and it has fallen less than the index. The reason being that we essentially are focused on quality as the core anchor of the stock selection. And these type of stocks tend to be less vulnerable to economic cycles, less, their earnings tend to fluctuate less compared to, sectors like, say, commodities, which are more sort of cyclical. And so essentially this fund, we believe, is actually less risky, or it's designed to have a lower volatility and lower risk as compared to the index, because inherently it is a quality anchored strategy. That's why.
So the risk part is taken care of, Aparna, but in the last year, the fund has really not gained a lot of return for the investors. In fact, since inception, also 13.97% return. Now, risk mitigation has been taken care of, but then what about the returns?
Yeah, see, to be honest, if you look at not just our fund, but you look at historically any literature or any experience of factor funds, or quant funds which are based on these kind of characteristics, they've always had a cyclicality in their returns to the extent. So in fact, while long-term factor returns tend to be positive, or there is an excess return attributed to factors, it comes over a longer time period, and it's very common for factors. It's not common. There is no factor which has not gone through essentially cycles of underperformance. Let me put it that way. So any factor would go through its cycles of outperformance and underperformance, and and this is a very natural and common thing which investors should very much expect. And this type of underperformance can persist for fairly long periods of time. There was a time in not in the very recent past where strategies anchored around value had underperformed for 2-3 years. What I'm trying to say is nothing unusual about this. So that's why we feel that these type of strategies are, investors should have a longer term time horizon when you're looking at these kind of strategies. So like, that the premia essentially which you're trying to harvest from the factor, it will come only over a longer, it will come in a cyclical manner. It comes over a time period. It doesn't come linearly, and this is something very natural and something which has always happened in the past.
The expertise of a fund manager also tested, because markets inherently are very volatile, and when we talk
Yes.
about a rule-based fund which follows a particular method or calculation, the onus is not on a fund manager to generate returns, because then the investor, knowing that the markets are volatile, are banking on a particular fund and a fund manager because they trust their expertise and they trust their judgment and the kind of diversification or whatever approach is applied in the fund. Now, having said that, you're saying you've adopted a value-based approach, and every 3 months you reevaluate and reallocate things in the fund. Are you also planning to change your quant model, which can shift from value to some other factor maybe?
No, so we are a quality-oriented fund, not really a value-oriented. The core anchor is quality, and we are not planning to shift because one of the benefits of the quant model-driven funds for any investor is that these are very transparent. So any investor who is investing in the fund knows what to expect. So if, for example, you invest in the fund, you know that what type of stocks the models are going to select, and in a very transparent manner, and it's communicated in very clearly what the strategy is. So therefore it would not be correct on the part of the investment management team to just change it without sort of the just change it just like that essentially. So no, and as I said before, when a good strategy has always tries to sort of backtest it through different economic cycles, so that it's not it's robust enough, and we believe that if it's a time tested factor, there's a proper economic rationale for that factor to deliver excess returns. And if it's a sensible portfolio construction, finding out stocks with genuine strong businesses, looking at all the fundamental factors which tend to matter, then it will outperform in the long run. And therefore there is no need to panic for a short term outperformance or underperformance, but remain invested, so that you can get the benefits of that strategy over a long term. In fact, there's a lot of anecdotal evidence also, frankly, where
so what kind of an investor, Aparna, should be looking at DSP Quant Fund? This definitely cannot be one of those funds with which you start investing. You cannot begin your investment, with this kind of a funds, because it's so technical, it's thematic, obviously. But what kind of an investor should be investing in this fund? How much should be the allocation given to this fund?
No. We think that any investor with a long-term horizon and a preference for high-quality portfolio companies can invest in this portfolio.
All right. Thank you so much, Aparna, for being on the show. DSP Quant Fund. Now, that's the fund if at all you want to diversify and you are looking for some innovation or a thematic angle to your portfolio. We slip into a short break, but then